Why don't we go ahead and get started? So thank you very much for joining today. So my name is Mark Lamonica. I look after the individual investor business here in Australia. And today we're going to talk a little bit about financial advice, and we're going to talk about how you can get some of the benefits of financial advice, even if you don't use a financial advisor. So we'll explore what it is, and how you can actually get it, whether you use an advisor or not. But first, we have some housekeeping items to go through. Number one, we have an Instagram account now. So you saw that on the screen before for people that joined. So you should like our Instagram account because, like many companies, we have a social media team that gave us permission to have this Instagram account, and they're going to take it away from us if we don't have 300 followers by October. So anyway, like us on Instagram. But the important housekeeping items, anything you hear today is general advice. I don't know anything about you. I cannot offer any personal advice. If you're over in New Zealand, you can go get our FAP from our website, morningstar.com.au. And the New Zealand regulatory authorities would like you to go consult a financial advisor if you do want personal advice, which is what we're talking about today. So it's all very relevant. So with that disclaimer, I would also love questions. So if anyone has any questions, just send them through. We have one through already, which I will get to. But yeah, thank you. Thank you for joining. And anyone who is not sick of me after this, we're doing another one of these at 6 o'clock. We're going to talk about ETFs, 6 o'clock Sydney time. We're talking about ETFs, funds, and licks. So hopefully that should be good. I'll be drinking something other than water for that session. But let's get started. So I'll go back to that PowerPoint. You can see our Instagram page again. If I can manage to advance the slide. Okay. Let's talk in general first about the financial advice industry in Australia. So a lot of things have been happening. So for people who remember, there was, of course, a Royal Commission in 2018, the Hayne Royal Commission. Pretty interesting findings that certainly left a lot of people without a lot of confidence in the financial advice industry. Since then, regulations have come out and been enacted, and there have been a lot of changes, as you can see on this slide, to what has been going on in the industry. So number one, a bunch of advisors are leaving the industry. So there have been changes in education standards. There's certainly been more regulatory burdens, and a lot of financial advisors have retired. So you can see that by the end of 2023, we're forecast to have 50% less financial advisors in Australia. There aren't a lot of people right now studying financial advice. So not a great situation in terms of numbers. And of course, what does that mean? Well, a couple of things have happened. Number one, fees have gone up significantly. So you can see the median financial advice fees have gone up by 16%. So close to $3,300. And of course, with less financial advisors and higher fees, the number of advised Australians has fallen. These obviously are not great things, but let's spend a minute talking about the larger shifts in the industry as well, and some of the things that have occurred, and some of the things that were looked at during that Royal Commission. So we'll just add a little context to what we're talking about today. So originally, financial advisors, and this is going back way before the Hayne Royal Commission, were basically just product distributors. So many financial advice networks were aligned to banks or other product manufacturers. So when we say product manufacturers, an example is somebody who has managed funds. And the financial advisors were just a distribution platform for those funds. And that worked very, very well. And it worked through a commission-based system. So financial advisors were paid commissions for different products that they put their clients into. And so when we went back and we looked at 2010, before there were multiple rounds of reform, even before Hayne, 73% of the time, an advisor recommended products from his or her direct or indirect employer. Interesting. Shifted a little bit. What they started doing is coming up with what they call approved product lists. So these are lists of products that are approved for the financial advisor to put clients into. So when these lists came out, still when we had those aligned networks, 21% of those product lists consisted of in-house manufactured products. And of course, 79% were external products, so from somebody else other than their employer. But still, 68% of the time, the advisor put their clients into the in-house product. So not great. ASIC went in, did a review of basically advice plans that people were put on, found that 65% of reviewed customers did not demonstrate that the customer would be in a better position following the advice. So pretty poor. So one of the important things that we're going to talk about today is what is good financial advice, because we at Morningstar do believe that when provided properly, that financial advice can be very beneficial. We've done a number of studies on it, can be very beneficial to clients. We need to look at what that actually is. And of course, and I'll say sort of my bias here is I do not use a financial advisor. I believe anyone can do this themselves. So we're going to talk about how you can do that yourselves as well. All right, so moving on. Why is it so important to concentrate on either from an advisor or on some of the different concepts we're going to walk through today? It's because of something called the behavior gap. So the behavior gap is the difference in returns that occur from a product and then the investors that are actually in that product. So we do this study every year called the Mind the Gap study. Basically, it's looking at what is that gap? What is that gap behind the gap between what the product earns and what the clients earn? Now, why is there that gap? Well, basically, there's a gap because people are making poor decisions. They are buying at the top of the market. They are selling at the bottom of the market. They are chasing performance and moving from product to product to product. And by analyzing the flow data, so funds that flow into and out of these different products, we can see that investors are not actually even earning the returns that they see. So if you're looking for an investment, perhaps you would go in, and this is what many people do, they would look at historical returns. And by looking at those returns, they pick a product. Well, that doesn't necessarily mean that they are getting those returns. So because of trading activity and flows going in and out. So here you can see some pretty profound differences. This is huge, by the way. So if you look at over time what those gaps would mean, and I will say that the gap has narrowed since then a little bit because markets have done well, but that is huge. That can cost you a lot of money if you're talking about retirement and have a long timeline. That will cost you an enormous amount of money. All right, so what is good financial advice and what do we think you can get from financial advice? I'm taking a new approach today by throwing things over there. Since there's nobody else in the office, I can do what I want. My lunch is also sitting over there, so I don't have to clean up after myself. All right, the value of advice. We believe that good financial advice can provide you or save you from losing around 2% per year. Now, that is huge if we're looking at total wealth. Now, what do we mean by good financial advice? And I'll talk about sort of how we came up with this. Well, what do we mean is, and we'll go through these in details, a focus on goal attainment. So anyone who's been to these before where we talk about goals, it's something we believe in pretty strongly here at Morningstar. And we'll get into details on that. A total wealth approach. So sort of a holistic look at your total wealth and your goals and what you're trying to accomplish. The definition of risk that is used. So we'll talk a lot about that. So we did one of these last week, I think. It's all blurring together. Last week where we talked about risk. So we have very strong opinions at Morningstar about risk. And then, of course, portfolio construction. So how do you actually construct those portfolios? So the way that we came up with this 2% is we basically did a large survey of people who got advice from different places. And we looked at 4 different places. So guidance for investment. So one, we looked at financial planners. So a financial planner takes a more holistic look at your finances. We looked at, what we would call like a transaction broker. Or advisor, like whatever you want to call it, but basically somebody who is just putting through orders for you. So a transactional financial advisor that's really just focused on the investment side of things. We looked at friends. A lot of people go to their friends and take advice from their friends. And we looked at the internet. So looked at those 4 different sources and then looked at holistically how people were doing. So we went through a number of different categories around sort of personal finance and decisions that people make. So to try to get this idea of where value is provided. So the top of the list was this holistic financial planner, and really focusing on things like what we're talking about here. Next on the list was the internet. So, and this list is how people did. So people did the best that got a financial planner. Second was the internet. Third was friends. And fourth was this transactional advisor. So we're going to talk today about financial advice and what gets you into that financial planning category and what gets you into that transactional side of things, because you don't want to be there. It's worse than talking to your friends. And think about some of your friends. Maybe they're not the best people to give you advice. But anyway, those are the different categories we're going to look at. So let's go through each one of these. We have 2 questions already, which is exciting. I think, Shani, if you're listening, somebody wants you on the webinars. But yeah, Shani is actually on annual leave. So Shani is, and she's still watching this, interestingly enough. Makes you wonder if she has nothing better to do, but none of us do in New South Wales. But she's studying, actually. So she is going back to school. So she's spending some time studying. She has exams on Monday next week. All right, let's get into this. Let's talk about goal attainment. So once again, we are going to focus on what you should concentrate on to make sure that if you are working with an advisor, they are giving you good financial advice. And then, of course, what you can do by yourself. So that's sort of my camp, I guess. All right, so let's talk about this. So what do we mean by goal attainment? Well, there are different ways, and this is going to come up a couple times today. And if you've watched these before, have come up multiple times, because it's something I believe in a lot. There are multiple ways that you can provide financial advice or do planning on your own. And what we believe at Morningstar is that a goals-based approach is how you should go about planning out either your own portfolio and financial plan, or of course, how an advisor should do it. So what does that mean? Well, pretty simple, right? We're all investing for a reason. And that reason is to accomplish a goal. And that goal is obviously unique to you. It can be anything. It can be anything from retirement to buying a house, to buying a second house, to going on a trip. Whatever you are saving and investing for, you are trying to accomplish a goal. And the focus of everything else you do, so everything from asset allocation decisions to selecting securities, needs to be on that goal, or it needs to be based on that goal and what you need to achieve that goal. And we'll talk about this a little bit later when we get to risk. But what should you look out for if you're using a financial advisor? Well, once again, if they start talking about the investments immediately, then they're probably going to fall into that camp of a transactional financial advisor. You want them focused on the goal. You want them getting to know you, which we'll get into in a second as well, but getting to know that goal, helping you define that goal. And people do have problems on their own defining goals because you do have to be pretty specific about it. And it is difficult, of course, to do that if you're planning a goal that's way in the future, but at the same time, it doesn't mean you're locked into this for the rest of your life. So your goals obviously can evolve over time or even completely change. But make sure that if you are talking to an advisor, that they are talking about you and your goal and not the investments. So even though commissions have gone away, so commissions are no longer allowed for funds or LICs or ETFs or anything else, even though commissions have gone away, you still want to make sure that they're actually focusing on you and your goal and not the investment. So the investment, and if anyone's gone through a goal process, the investment should always come last. So be wary if you walk in there and all of a sudden they're pitching you something. So how do you do this on your own? Well, very easy. Well, one, you can sign up for Morningstar Premium. But how do you do this on your own? define your goal, specifically define your goal. I'm not going to go through the whole process. Figure out the return that's needed based on how much you're going to save and how much money you need to achieve your goal, and use that required rate of return to drive everything else you're doing. So to drive that asset allocation, to drive the selection of investments that go in there. Sorry, just checking the question to see if we have. Yep, I will still get to those. All right. I wasn't not going to answer them, but just see if they were specifically related to what I was talking about. All right, let's talk a little bit about a total wealth approach. So when we talk about financial planners, we're talking about a holistic look at your life, not a very narrow sliver, which is your investments. So once again, they need to get to know you, get to know what is it that's unique about your own situation. So everything around your plans for your family to, do you have elderly relatives you need to take care of or think you may need to take care of? Talk about your career, your job, what you're trying to do. Do you want to take time off at some point in your job? You do need somebody to actually get to know you. So once again, a big red flag with an advisor is if they don't want to get to know you. And they're, once again, very focused on a narrow sliver of your whole financial life, which is your investments. Now, how can you actually do this on your own? Once again, people struggle with this. But it is important to sit there and look at your life and look at the different factors that are going to influence your financial well-being. So first of all, look at your career. What are the different factors that could influence your career? Is that going to somehow be an input into what you're doing financially? So, simply like, where does your salary come from? Is it a salary? Is it commission-based? And it can vary. Are you part of the gig economy where you can have large differences every month in how much money you make? And then what are the influences that actually drive compensation? What would cause you to get a bigger raise or to have it dialed back? And think about the different market and economic forces that would do that, because that way that can be an input into your portfolio. And a simple, like, if I use myself as an example, I work for a firm in the investment industry. So obviously a couple things could happen at once. If the market started performing very, very poorly, my job could be at risk. Wow. My investments didn't do well. So what would that mean for me? Well, think more larger emergency fund. So it's just things like that and thinking about different factors that would influence how you do. So, same thing that we see a lot of this, right? That people naturally gravitate towards investing in things that they're comfortable with. So we see a lot of people in the real estate industry that where are they interested in investing their money? In real estate. And obviously things have gone very well here for a long time in real estate, but what would a downturn do? Well, potentially you could lose your job or your income could be reduced while your investments were doing poorly. So it's just thinking about that. So we talked about your family. Who are the different dependents that you may need to take care of? Some dependents don't necessarily have to be your kids. They can also be your parents. So something to think about. And then, think about sort of where you live. What are the different influences on your overall life? So once again, think holistically about your own financial situation. Make sure your advisor is getting to know you and understands these things. They should be asking you this. Once again, if they just move straight to the investments, it could be a problem. All right, so let's talk about risk. So we did a whole webinar, obviously, on risk. Once again, I don't remember when, last week maybe. So what you are required to do as an advisor is you are required to create a statement of advice for people. And that statement of advice, in many cases, starts out with a risk tolerance questionnaire. And I personally, and we at Morningstar, aren't wild about risk tolerance questionnaires. There's some that are better than others. What a risk tolerance questionnaire is, it's basically simply going through and asking you how you would react to certain things happening. So if the market went down 30%, what would you do? Would you sell everything? Would you put more in the market? Would you do nothing? Things like that. And then it'll ask you some demographic questions like, how old are you? Are you married? Do you have kids? Well, none of this stuff, in my opinion, and I think numerous academic studies have shown really matters. Because here's the problem with this. Number one, it is almost impossible for a human to predict how they will react to something under a high stress situation. And a high stress situation, of course, is the market falling significantly. So us trying to assess that just doesn't work. The other thing that happens is, of course, as investors, our risk tolerance shifts over time, and it shifts in the opposite direction it should. So when the market is going up significantly, people get more confident, but they shouldn't, right? Like mathematically, you shouldn't get more confident. As the market goes up, you should think that next year has a greater chance, because it does, of the market going down, right? So something important to keep in mind. The other thing is, of course, as the market falls, people become more risk averse. So that's why people sell when the market is falling. And that's not a great thing either, right? You should be more confident in the valuation levels of investments as the market falls. So that's the problem, right? Risk tolerance questionnaire doesn't work. People's risk tolerance changes over time, which also makes it somewhat pointless. But the reason people are going through this is it's a little bit of a check the box activity before they get into your asset allocation. So how do we think you should think about risk? Well, the biggest risk that people face is not achieving their goals. So that, once again, is just the fact that investing is a means to an end. So if you don't achieve your goals, what good is the rest of this? And the problem is, let's say let's say a risk tolerance questionnaire was completely accurate and didn't have any of those problems I talked about. I go and I fill out the risk tolerance questionnaire, and it says you're very conservative. So you're conservative, you do not want to deal with market losses, you wouldn't deal well with them. We're gonna put you in a conservative portfolio that's 50% defensive assets. Well, why does any of that matter if I need a more aggressive asset allocation to achieve my goal? Is being conservative and keeping a bunch of cash going to do you any good when you hit retirement and you have half as much money as you want? It won't. So the focus needs to be on risk capacity. How much risk do you need to take on to achieve your goal? So a lot of advisors are goals-based advisors. Just make sure that they are talking through this with you, talking through this concept that, okay, you need to achieve your goal. So whether you're comfortable taking on this risk or not, and it's ultimately your choice, if you don't take it on, you will not achieve your goal. So that's the way that we think you should approach risk and asset allocation. And we, of course, have tools on Premium that help you do that. So the required rate of return calculator. So basically what that does is it calculates where you need to get from where you are now, or what you need to earn from where you are now based on your savings and future investments to where you want to be. And that return that you need to achieve has to drive decisions, right? It can drive a couple different decisions. Number one, asset allocation, right? If you have an 8% return that you need to achieve over the next 30 years, regardless of what a risk tolerance questionnaire says, and you're sitting in cash, you're not going to get it, right? So that's the example. The other thing it can allow you to do is, if you don't want to take on that much risk, you should be realistic and adjust your goals at that point. So if you're not willing to invest a significant portion of your portfolio in the share market, then perhaps you need to take that retirement goal back, or you need to save more, or you need to delay your retirement. All right, finally, we get into portfolio construction. So the reason this is last is because this should be the last thing that you're doing. So once again, the red flag that we talked about over and over again is that people jump to this in the beginning. Now, there are many different types of financial advisors. There are financial, and none is good or bad, but you should also be aware of sort of their approach. There are financial advisors that will select the investments themselves. So whether that's the advisor or the overall advisor, whatever advisory group they're in, that they will actually go through, they will select all the different investments. Then there's a lot of advisors that outsource all of the investment side of things. So they will focus on all the stuff that I talked about before, figuring out your goals, looking at your holistic financial situation, working on asset allocation, deciding what asset allocation is needed to achieve your goals. And then they will outsource the investment. They'll find an investment company that just does the rest of that. Now, neither one is good or bad. There are just good and bad approaches with sort of, in general, financial advice. So how do you do this on your own? Well, once again, it's just starting with what you're trying to achieve, that required rate of return into the asset allocation, and then thinking through what is the way that I am going to select investments that make sense given what I'm trying to do. Thank you guys for joining. Anyone who does want to come tonight, if you don't have a registration, you can just email me, mark.lamonica1@morningstar.com. You can email me any other questions that you'd like as well. And for anyone who is not sick of me, we'll do this at 6 o'clock Sydney time tonight. So thank you guys for joining. I appreciate it.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.